Good evening, everyone, and welcome to the Brian Crombie Radio Hour. I've got an interesting series of gentlemen to introduce you tonight, and an opportunity that I thought think makes a lot of sense. A lot of people have been talking about the real estate business in Canada, what's going to be happening with our real estate business, given interest rates, given the economy, given the threat of Trump tariffs, etc. And people are a little bit worried. And I've recently been exposed to an interesting company in the Midwest United States that's got a really fascinating strategy, and I thought it would be really helpful to talk about it a little bit as a potential alternative strategy for people that are interested in investing in real estate, but a little bit concerned about the real estate opportunities in the Greater Toronto Area in Canada today. And so I want to introduce you to two gentlemen from Denton Floyd, a company in the United States, Midwest, and we're also hopefully going to be joined by a real estate advisor, analyst, expert who is knowledgeable about both Toronto, Canada, as well as the Midwest, and have his opinion about the alternative investment vehicles. So maybe I could ask the two gentlemen, Mark Crane and Patrick Richardson, to introduce themselves and tell me a little bit about them, their background, and Denton Floyd. Mark, why don't we start with you, sir?
I'll kick it off. Thank you, Brian. Yeah, I'm Mark Crane, everybody. I'm the president of the Capital Markets Group at Denton Floyd Real Estate. Patrick is on this very small and focused team that basically work on assembling the capital for our real estate developments in the U.S. My background basically has been involved in some form of financing, venture capital, seed funding, real estate investing. Started doing real estate investing with Denton Floyd about 12 years ago. And as the company has grown and the projects have become more diverse, I have grown with the company, gotten more and more involved as a partner and, again, running the equity capital markets group. And I'll introduce Patrick briefly. Patrick is one of our VPs, and he's been basically intimately involved in building all of our financial models, working with both banks and equity partners. Patrick, just tell them about your background.
Yeah, thank you very much for having me. Been at Denton Floyd since 2019. My previous life, I was a CPA at the largest CPA firm in Louisville, Kentucky. Moved over here in 2019, started as the controller on our development and construction company, switched over to the capital markets team in the last couple of years. Worked primarily with Mark and the rest of our team, underwriting the markets, creating the Excel models, the decks, running due diligence on both the debt and equity side, and hoping to get the deals closed. Thank you very much for having me.
Well, thank you guys very much for joining me. So I was exposed to you guys in a couple different ways. Number one, at the real estate forum, you presented to the Canadian investment community, which was really kind of interesting. And then separately from that, I've had the opportunity to take a look at some of your proposals and actually visit Louisville, Kentucky. And maybe we'll come back to that because fascinating town with real history and bourbon that maybe we can chat a little bit about. But let's talk about the pitch that you made at the real estate forum. You came to Canada and you presented to a couple hundred, if not 1,000 people at the real estate forum with the strategy to invest in what I would describe as suburban multifamily residential developments along up and down I-65 in the Midwest United States. And I think a lot of people that are going to be listening to this radio broadcast are familiar with I-95 because it goes up and down the East Coast of the United States. A lot of us take I-75 to drive to Florida if we're interested in driving to Florida from Ontario. But not many of us are familiar with I-65 and what towns are along I-65 and why investing in the Midwest, which you've represented as growing economically, makes sense. Maybe Mark or Patrick, you could tell me a little bit about sort of this I-65 suburban multifamily strategy and why it makes economic sense.
Well, let me just kind of give you a little context, and then Patrick, I'll cue you to bring up the map that I want everybody to see in just a moment. But look, everyone knows why people are interested in going to Florida to vacation and to live. Everybody knows why people like to go to the mountains. But why would people want to go to the Midwest? And when I say the Midwest, I'm talking about that I-65 corridor that Brian just referenced, which is kind of there on the edge of the Midwest and sort of the foundry in the Southeast. And the reason why I-65 is such a hot opportunity for real estate development is because it is strategically located almost in the dead center of the U.S. population, at least the eastern U.S. population. This is where I want Patrick to bring up the visual. So if you want to think about where a company wants to go, if it makes and moves a product, it does want to go at the tip of Florida, where it's, way far away from people that are in the top northeast of the country. You want to put, facilities and your logistics operations where it's easy to get raw materials in and it's easy and efficient to get finished product out. And if you draw a 500-mile circle around the area where Patrick's got his arrow right now, that is kind of right in sort of the geographic, center of the density of the U.S. population. Basically, where that arrow is pointing is right along that I-65 corridor between Indianapolis and Louisville. And those two cities, Indianapolis, Louisville, they are the premier logistics distribution hubs in North America. UPS has its second largest air hub in the world in Louisville to do overnight delivery from there. It also has just an incredible ground transportation system, of course, there. Indianapolis has FedEx, and they have their international air hub, and they also have a large ground operation. So along I-65 between Indy and Louisville, best place in the world to make and move a product. And that's why you see so much investment coming in now from manufacturers, distribution companies. And what comes with that are jobs and workers who typically make, $25 to $35 an hour. And those people need housing. There is a massive, massive shortage of workforce housing in that I-65 corridor, and that robust demand continues to make that gap widen. If you look at any CoStar report in the last year or two, you'll see that Indy and Louisville are two of the top 5 markets in the whole U.S. for rent growth because of that robust demand and what has been a limited supply. Now, developers are going to figure this out eventually, but you're hearing about it first now. Denton Floyd has known about this for a while. There is more demand supply triage here in this part of the country than anywhere. Is that helpful?
That is. And so let's just do geography for a second. So I-65 sort of starts Chicago and then travels south from Chicago. And what are some of the major cities that it hits that people are going to recognize the names of as it travels south?
As I'm narrating it, Patrick, if you want to go to Google Maps and just show them, it starts at Chicago, it goes south down toward Indianapolis is the next major city, kind of goes past Purdue University and West Lafayette, hits Indianapolis, and then almost dead south of Indy, about 2 hours, you come down through kind of Columbus, Indiana, and Bloomington area where IU is in Indiana University. Then you hit Louisville. So zoom out just a little bit, Patrick, so those who are watching can see the
So Indianapolis, Indiana, Louisville, Kentucky.
Yep. Chicago to Indianapolis, Indiana, then straight down. Louisville sits right on the border of Indiana, Kentucky. So you hit Louisville on your way into Kentucky, and then come on down from there, and you'll go south down to Nashville, Tennessee. Most of you have heard of Nashville. And then you continue on down I-65. It goes on down to Birmingham, Alabama. And eventually it makes its way all the way down to Mobile, Alabama, which is the bay there on the Gulf. So this is the north-south corridor that is in that major kind of central eastern U.S. area.
And the cities that you're focusing on are Indianapolis, Indiana, and Louisville, Kentucky. Is that correct?
Those are the two primary cities. Yeah, we've got a few things
and
south.
Even in those cities,
Nashville.
Even in those cities, you're not downtown. You're in the suburbs.
That's right.
Is that correct?
That's right. I mean, these facilities that people work in are not downtown. They are in places where they can get land to build their plants and build their distribution centers. And we're just kind of following the jobs. So they're generally going to be in suburban areas. We generally go in once there's some decent retail in the area. So we look for things like, the kind of retailers that we know do good research on growth. Groups like Chick-fil-A and Publix grocery stores and Panera Bread and those kinds of things. You'll see that kind of Class A retail in these suburban markets where we locate.
Actually fascinating. And, I think a lot of people in Ontario and a lot of people in Canada wouldn't be familiar with the growth, but you're saying population growth and economic growth.
That's right. Population growth and income growth are the two major metrics that we underwrite when we're going and looking at the attractiveness of a certain submarket.
This is a really interesting opportunity. We're going to sort of take a break and then delve into the investment opportunity and the properties that Denton Floyd are investing in. If you've intrigued at all by this conversation and you want to get further information, go to terracap.ca or nexuscrowd.ca and you can get additional information or just send me an email and I'd be happy to contact you with the gentleman and the opportunities that exist at my website, briancrombie.com. We're going to take a break for 2 minutes and come back in 2 minutes after some messages. Stay with us, everybody. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour. I've got an interesting business opportunity, a real estate investment opportunity to recommend to you today and to consider. And it's kind of interesting because rather than the vast majority of us that have wanted to invest in real estate, we either invest in our own homes, or the big trend in Canada in the last little while has been investing in condominiums. And often those condominiums are pre-construction condominiums that we end up renting out. And that market is terrible right now. It's in a crash, and I think a lot of us know that. And so I've come across an interesting investment opportunity in the Midwestern United States that is up and down I-65. The two cities are Indianapolis, Indiana, and Louisville, Kentucky, and a company, Denton Floyd, that really has perfected a strategy of building low-rise, multifamily residential developments in the suburban locations for regular people that need a place to live. It's rental accommodation. They take care of all the landlord stuff, but they actually want people like us to invest in them. And if you're at all interested in this, you can go to terracap.ca or nexuscrowd.ca or send me a message on my website, briancrombie.com, and we can get additional information on this. It would be for accredited investors that have to have a certain net worth, but I think it's something that is of interest to a lot of us of what these investment opportunities are. I'm joined by Mark Crane and Patrick Richardson from Denton Floyd that are going to be chatting a little bit about it tonight. We've talked for the last couple of minutes about the strategy, and lots of us know about I-95 that goes along the East Coast, I-75 that we travel when we go to Florida, but I-65 goes sort of through the Midwest and starts in Chicago, then goes down to Indianapolis, Indiana, and on to Louisville, Kentucky, down to Nashville, Tennessee, and then down to Mobile, Alabama, right through sort of the middle of a lot of the population concentration in the United States. Mark has talked about how that's really right in the middle of a lot of economic development, population growth, particularly as we think about logistics. I had the privilege of going to Louisville, Kentucky, and driving around the city, really fascinating city, growing like crazy, and has these Amazon warehouses and other distribution facilities that are just massive, unbelievable, and an airport that has got freight air freight traffic coming in and out on a daily basis, and obviously thereby creating huge amounts of jobs and therefore needing some real estate development. You guys have got an interesting strategy that is to go, and maybe you can talk about it a little bit, building really, it's what, 3 and 4 story multifamily apartments with wonderful amenities not on the outskirts, but sort of in the suburban locations, as you said, Mark, close to retail, close to major highways, close to those logistics employment zones, and you get great occupancy. Tell us a little bit about some of your developments, if you could, and give me a little bit more elaboration on the strategy of what you're building, how you're building it, why you're building what you're building.
Yeah, and this is Mark speaking, and I'm going to let Patrick talk about some of the numbers here. But look, our strategy is at a high level is real simple. We go in and build at a cost that once we have it fully stabilized, after we built it, looked at the income on the property, we want to be able to go in at basically a 7 to 7.5 yield on cost rate. That's a really important number in the underwriting of these deals. And Patrick's a CPA by training. No one knows the numbers on a multifamily development better than Patrick. He's lived them basically his whole life. And he builds all of our models, analyzes them. But we want to build in an area where we look at the total cost per unit. We look at how that compares to the other properties in the area, how much it would have to rent for to basically get to where when it's stabilized, we would be able to sell it for a nice lift in terms of the sale cost per unit. And in terms of an exit cap rate, which a lot of people who do analysis on multifamily will tell you is a key metric, we generally are in markets where the exit cap rate's about a 5% exit cap.
5%, that's spectacular.
5%, yeah, 20 times NOI, basically. It's a 20x multiple on net operating income. That's what you've seen in Louisville and in Indianapolis for the last 25, 30 years. It's gone up and down a little bit. It might go up and down 25 bips, but we sold an asset for less than a 5 cap. Last year, we're closing on one in 2 weeks. That's also just under a 5. This is a 5 cap market. So if you can build at a 7, if you can build it all in for essentially a 7% yield on cost and then exit at a 5, that's going to generate a really nice return for both our investors and for Denton Floyd. And so we love these markets that have been overlooked by U.S. developers. And you just described them, Brian. These are basically middle of the country cities that have robust demand, not crazy demand like you see in Austin and Nashville and maybe Tampa, but good steady demand because of the job growth. And developers are all kind of overlooking this area. They're going down to places where things have been overbuilt. There's still a great opportunity to fill a huge unmet need in the mid-US. So what Patrick's going to talk about briefly are the numbers, just sample numbers on a deal here in Louisville. It's called Shepherd Springs. This is a pretty typical Denton Floyd deal. It's
Before you
a
get to that,
large scale
before you
project.
get to that, can I ask a couple of questions? So,
Yeah, sure.
how many units would you have in one of these developments?
Yeah, Patrick, go through some of the numbers with the group here.
Yeah, absolutely. So our typical build is between 250 and 400 units. We build the same exact
250 to 400 units. How many floors?
typically three floors, sometimes four floors, depending on the size of the parcel. We typically have a 15 to 20 acre parcel, and we'll go 3 stories, no elevator.
3 stories, no elevator. And what type of construction? Are you wood? Are you concrete? Are you a combination? What's your construction?
Yeah, wood, surface parking. Basically, the rule is if you go above 3 floors, you got to add an elevator. So if we do go 4 stories, we'll add one. If not, it's just walk up. 15 to 20 acres. The key that we have, and you'll see in a second on pricing, is we have one bedroom floor plan, one 2 bedroom floor plan, and one 3 bedroom floor plan. So we build the exact same product anywhere we go. If you look at a deal in Indianapolis, Louisville, Cincinnati, Ohio, it's the exact same floor plan. So that allows us to control costs and have a very competitive price per unit all in, which you'll see here in a second.
What are the
May shock
average
you.
sizes of those units? We've in Toronto have been looking at unit sizes that are 500 or even less square feet per unit. What on average? What are the unit sizes that you've got?
Yes, so at our apartments, they almost feel like a home. A 1 bedroom is 819 square feet. A 2 bedroom, 2 bath is 1243 square feet, and a 3 bedroom, 2 bath is 1525 square feet.
Those are
So they're
huge. Those are spectacular unit sizes.
very large units. They all have, walkout balconies or patios. You can fit 2 bikes in the patio storage. So, washer and dryers in the units. It really feels like you're at a home, with a lot of very nice amenities and high-end finishes.
Tell us about some of the amenities.
Absolutely. So I'll share my screen for the people that are seeing online, but what we try to do is right when you walk in the clubhouse, it feels like a resort. So you walk in there, we'll have a nano wall that looks straight on to a 10-foot fountain. You can hear the water running right when you enter the clubhouse. Feels like you're walking into a high-end resort right when you walk into our leasing office. We'll have a golden tee. We'll have cooking grills. We'll have putt-putt, hammock park. We even have 2 dog parks. We have one for large dogs and small dogs.
Two
Uh,
dog parks
2 dog parks. Yeah, absolutely.
and a
Uh,
big dog, washing station or room.
Absolutely. Yeah, we've got a pet wash. Something else that's very unique is we have a car wash as well for the residents with a high-end vacuum and wand, which actually gets a lot of use. We've even started incorporating a meditation little pod in the clubhouse, so you can get your Zen on and really relax at our facilities. Another thing that we've added, which has been very beneficial during COVID, is we've added individual working pods within the clubhouse. So a lot of people, are remote from home or at some part of a remote, and you can go in there, close the door, take meetings, so that if you get tired of working out of your apartment, you can change it up and go to the clubhouse. We have Starbucks machines in every clubhouse so that people can get as much coffee as they want. And we've even started incorporating cyber cafes where it's an unmanned station. So you can go there, grab a Snickers bar, grab Coke, automatically charge your card. And, it's not manned, so it's easy to manage. We just try to provide as many amenities to the residents at an affordable price.
Fantastic. And what about in the units? Give us a sense of what do you find in the units? What kind of finishings? What kind of appliances, etc.
Yeah, absolutely. So we have 42-inch cabinets, quartz countertops. We have backsplashes all the way up to the cabinets in the kitchens. Something unique, and this is double vannies in every bathroom. So even in the secondary bathroom, you've got 2 sinks, which is not too common in all apartment complexes. You've got the walk-in shower in the main room and then the tub in the secondary. LVP LVP flooring in all the areas except for the bedrooms. We primarily do that because we don't want someone walking around in high heels or dress shoes in the morning, and the people up or above they're trying to sleep can hear them. So LVP everywhere except the bedrooms. And washer and dryer is a huge advantage. Some apartment complexes you've got to rent that, which is a huge hassle on the tenant. Or they could rent it from the facility, but that's probably $50 to $75 extra a month. So it's a really nice amenity that we have. Oversized units, like we talked about before, there's a balcony or patio on every unit where you can store 2 bikes. And then the 5-panel doors within the units, I think, give it a really nice touch that, make you feel like you're at home.
I've had the privilege of touring your units. They really are quite beautiful, and the amenities are unbelievable. And I really get the sense that these clubhouses are places where people spend a fair amount of time and go and meet friends and end up, having a real community feel. What's your sense of that?
Yeah, the fire pits are a big reason for that, Brian. So fire pits have become, I think, the most popular amenity at these clubhouse communities. Of course, the pool is always popular in the summer, but year round, we have 12-person fire pit stations we put now around the pool inside the area. And just a natural place to sit and gather, hang out, meet residents. Every time we go to a property, we see people sitting around that talking, and it really builds a community. I mean, these people really get to know each other, and they feel safe, and they want to protect the lifestyle that they have, because this is home, and it will be home for some of these people for several years. I mean, we'll have some residents who will live with us for 10 years in these places.
Now, rents in Toronto would be $4 or $5 per square foot on average. What kind of rental rates are you charging?
Yeah, it's definitely way more reasonable here. So on the 1 bedrooms, we're marking to $1.80 per square foot. 2 and 3 bedrooms are between $1.44 and $1.48 per square foot. With the larger unit size and the affordable prices, the per square foot is nothing too crazy.
You give them the chunk rents there, Patrick. Just tell them kind of roughly what the 1s, 2s, and 3s are going to rent for on average.
Yeah, absolutely. So 1 bedroom would be about 1478 square feet. Or sorry, 1478 per month. 1819 square feet, 819 square feet, so $1.80. The 2 bedrooms are 1844, and the 3 bedrooms are 2196. So very affordable.
And to be clear, these are U.S. dollars we're talking here. So those numbers will be a little higher when you convert them to Canadian dollars, but that's the U.S. numbers.
It's still very attractive. You're able to make a reasonable return, a 7% return based on those kind of numbers?
Well, so the total return to the investor is going to be projected over a 20% annual IRR. It really has to be competitive enough to kind of win the investor equity that we need. We have to do a model that gets the LP at least a projected 20+% return. Now, there's an 8% preferred return that's built into the model. So all the first cash goes to the investors. It pays an 8% preferred return and returns capital. When you look at the split beyond the return of capital, we typically do about a 70-30 split. That typically sets the return characteristic again in the low 20s. Will we hit that on every deal? No, we won't. But we'll hit it on some, and the ones we don't hit it on will still be in the high teens. Which for an asset in this class is still very, very competitive.
So what's the secret to you being able to charge rents that are, 1/3 what we would see in typically in Ontario, and still make very attractive returns? Is it, better construction, lower construction cost, lower land cost? What's the secret?
Well, there's one kind of big factor, and then there's a couple of smaller factors that contribute. The biggest factor is the cost of land. I mean, quite simply, we need 15 acres. I mean, to get 15 acres up in Canada, near any of the places that I've visited with you, Brian, it's a much different proposition than buying that land on the outskirts of Indianapolis or Louisville. So you're going to see the effective cost per unit when you look at the land element of it, very, very low in the Midwest, much higher in Florida and some of the markets like that. But you're going to see that's one factor. For Denton Floyd, another big factor is the cost of our materials. So when we go out to bid the big stuff, the windows, the doors, the countertops, the appliances, we don't just go say, hey, can we get a price on 300 units we're going to build outside of Louisville? We actually show our suppliers our whole pipeline. Right now we have 10 to 12 projects that we're going to start in the next 18 months. Represents about 2,500 units, right? So we can go and show a $2,500 order to a Samsung or to an LG and see what kind of pricing we can get in bulk. And so that bulk pricing allows us to get that cost of materials down, ultimately the cost of construction. And then we have insourced our construction management. So we're not paying a margin to a GC. We've gotten very efficient on our controls and our cost control. And we build the same thing over and over, as Patrick mentioned. When you're building the same widget, you get really efficient at it. There's not a lot of variability once you get the groundwork done and you're going vertical. I could literally blindfold you and take you to 3 different properties, and you would think it's the same property because
They
we
look
build
exactly the same. So you're just building it over again.
Yeah. So all those are things that add to the efficiency. And ultimately what we build for is, well below the national average. Our all-in cost per units right now on our Class A properties are about $220,000 to $240,000 a unit in US dollars. Okay. 220, 240. Now that's going to go up over time. It's gone up a lot in the last couple of years, actually, but we're still going to exit these deals. When you go look at what these will trade for when they're stabilized, they're all going to trade for something north of 300,000 a unit. And, we feel very good about coming in at these price points, holding them, stabilizing them for 3 or 4 years, and then either selling them or doing a federal refi with one of our agencies here in the U.S.
It's a fascinating strategy that you've got. I sort of think it would be comparable for people that are listening to this in the Toronto area as going up and down the 401 from sort of Waterloo to Windsor, and thinking about being at every major town that has got big employment growth and factories and things like that, and being in a suburban location around Kitchener or Cambridge or Waterloo or Windsor, and it would be a comparable strategy, finding housing
Yep.
that is cost effective on cheaper land for people that have got great jobs in all those factories. If that was the industrial heartland of Ontario, what we're talking about in Indianapolis, Indiana, and Louisville, Kentucky is sort of that the logistics heartland of the United States. As I mentioned, if you're at all interested in this, go to terracap.ca or nexuscrowd.ca or send me a message, and I'll connect you up with the opportunity. We're going to take another break for some messages, and when we come back, I'm going to talk about some of the economics of why this might make sense as an investment opportunity and how exactly you go about it. And we're going to compare it to some other opportunities that people might have. Stay with us, everyone. We'll be back in just 2 minutes with the Brian Crombie Radio Hour. Welcome back, everyone, to the Brian Crombie Radio Hour. I've got a really interesting investment opportunity or idea to talk about with you all tonight. We've been chatting with Mark Crane and Patrick Robinson from a company in the United States Midwest called Denton Floyd, and they came up to Canada at the Real Estate Forum back in the fall and presented to 1,000 people about the opportunity to invest in the Midwest United States in multifamily residential apartments. These are 3 and 4 stories, so they're not like the big apartment buildings that we're familiar with. They're low rise, and up and down I-65, which goes from Chicago to Louisville, Kentucky, to Nashville, Tennessee, through Indianapolis, Indiana, etc. Where what Mark has talked about is a whole bunch of the logistics companies that DHL, FedEx, etc. have located big logistics facilities and created great economic development, great economic growth, employment opportunities, and Denton Floyd is building housing for them. I thought it would be interesting to talk about this because a lot of us have invested in real estate, and we've invested in real estate by either buying pieces of shopping centers or by buying a couple of condominiums that will then rent out. And here, what there is a tough market for the condos today in Canada, clearly, but a real estate investment opportunity where you don't buy a couple of condos and end up being the landlord yourself. What you're doing is you're investing in a entity that is going to build these multifamily residential developments and take care of all that. They're going to do the construction. They're going to do the lease up. They're going to be the landlord, and they take care of all that that administrivia, construction hassle, etc. And you'll just get hopefully a distribution. Mark, maybe I could turn to you when thinking about real estate development opportunities. Why would this be attractive? Why would this make sense conceptually? Not Denton Floyd specifically, but the idea of garden style apartments or your style of mid-rise apartments versus buying your own condo and renting it out.
Well, you just kind of touched on the main reason. So there's 3 ways to invest in real estate. And you just talked about one of them, Brian. You buy your own condo and then you either manage it yourself. I mean, a lot of my friends did this. They bought condos down in Florida, and the spouse, was the one who leased it up or hired a management company to do that. And you can do okay with that. Typically, you don't make money till you sell it, and it's a lot of work. You got to be the one that, that collects the money and calls vendors. And so that's one way to do real estate. The other way is to buy a REIT stock, right? You can go and you can buy a publicly traded REIT. Those are generally not very exciting stocks for me. They usually provide single digit kind of annual returns. But they are a little more liquid. The way that I like investing in real estate that I didn't know about until about 12 years ago when I met Denton Floyd, is to invest in a limited partnership where there's a general partner that is the operator, and then there are limited partners who are the passive investors. And that model is what I've invested in over the last 10, 12 years, and that I'm now working on behalf of Denton Floyd to put together with new investors. And so it works much like this. There's an operating, there's an entity that's created, a new legal entity that stands alone. For each one of our apartments, it has its own legal structure. It's typically a limited partnership or an LLC. And then there's an operating agreement that says, okay, the investors are going to be limited partners who have certain governance rights, but the general partner is Denton Floyd, and they're going to have basically the operating control and really the responsibility to do all of the work. They have to build it. They have to fill it up and lease it up. They have to do all the reporting, the monthly reporting to investors and to the banks. Essentially, the limited partner simply invests and then monitors the investment and generally enjoys an economic return that's really, really attractive compared to most any other alternative investment. And in the US right now, it is far and away my favorite alternative investment. So what are the returns? They're generally going to be in the upper teens, low 20s as an annual return. Generally, your money is going to be probably invested and locked up for a minimum of 3 years, but probably not more than 5. So there's a liquidity window that seems reasonable there. And, when I look at investments for myself, and I have, again, slowly but surely been moving money into more and more real estate and multifamily and specifically limited partnerships, it's because I'm looking for these things. I'm looking for downside protection. I'm looking for good, decent upside potential. I'm looking for some certainty on when I'll have liquidity, when I'll get the money back. And then fourthly, and this one's really important, I'm looking for transparency. I want to know what's going on with my asset at all times. And Denton Floyd has been able to check all 4 of those boxes for me, and other sponsors do this as well. You want to make sure the sponsor is, first of all, able to build it, able to lease it up, has a good track record of operating a property to get it to where it can be sold or refinanced, and that they are reporting monthly on the progress of the asset. And as long as you've got someone who's doing that, you don't have to call vendors. You don't have to worry about dealing with tenants. I mean, it is the best way to enjoy the economic benefits of real estate without actually doing the work. And it only works in the U.S. really well, I think, in 3 asset classes, which are multifamily, student housing, and senior living. Why the reason those 3 stand alone is because they're the only 3 that are eligible for federally subsidized funding. So when you get to that stabilization point, if you don't want to sell it or it's not a good time to sell it, the federal government will give you subsidized debt to take out your construction loan. That's generally going to return all of your capital back to your investors, and you can just hold it till it's a good time to sell. But those are the 3 favorite asset classes in the U.S. right now. It's multifamily, student housing, senior living. Denton Floyd dabbles in some senior living. We don't do any student housing. Our bread and butter is multifamily, and it's a very specific type of product, which we discussed on the previous segments.
It's not high rise. It's typically this low rise.
Typically, that's the case because typically what we're doing is we're going out to a suburban market. We're getting away from the urban core where there's not as much density as there is in the city. And when you look at the cost efficiency to build our 3-story garden style property versus, a 7-story or whatever tower, the cost to build, the overall cost per unit is more favorable in the garden style configuration. And it's because we don't need elevators. It's because we build the same widget over and over. We don't need to pay a ton of money to re-engineer it and re-architect it. We know our building. Once we get the pad on the ground, we know what it takes to put the building up on the pad. And we've gotten very, very efficient at this particular asset.
You had said that you're going in a return to cost is about 7%, and then your plan is to sell ultimately at a disposition cap rate that would be at like 5%. So
That's right.
7% in and 5% out. How do you get returns up in the high teens or 20? I presume you've got to put a bunch of leverage, a bunch of debt on the.
We do.
project.
We
Is
get
that
as much
correct?
leverage as we possibly can because when
And
you
so
look
what
at
would that be on average?
Yeah, so we try to get to 75%. That's what it was until 2 years ago. We would get a 75% loan to cost on every deal. Now, since the market started going crazy 2 years ago with interest rates, that leverage point has come down. Patrick, the lowest we've done on any deal is 68%, maybe.
Correct, 68, but 70% I would say has been the sweet spot the last couple of years. And that's from regional and local banks. You know, the large U.S. banks, the PNCs, the Fifth Thirds, you know, they've been at 55, 60% loan to cost over the last couple of years, and they're probably in the low 60s now. But a lot of these banks that are around our area that we've established relationships with over the years have been able to give us, you know, higher leverage points, which only helps the returns to the LPs.
Okay. And so in addition to the benefit of leverage, you're offering investors a preferred return of 8%. Is that correct?
That's exactly right. Yeah, they get a preferred return of 8%. The cash that comes out of the project, when it starts generating cash, it pays down that 8% first. Once the 8% pref has been fully paid, then we pay down the capital investment from the limited partners. So Denton Floyd doesn't see a dollar until all of that has been paid back, the pref and the invested capital. And then after that's all been paid, then we get into a split. And we engineer the split on each deal to make sure it looks like it's a reasonable proposition to the investor. It's generally about a 70-30 split, but it can vary a little bit based on a project. If it costs more, costs less, if we have incentives. Sometimes we'll do as much as a 60-40. Sometimes it'll be a 75-25, just depending on the deal.
And so
I
you're
think
saying that,
sorry,
go ahead.
I was going to say, I think two other key points about the debt is Denton Floyd guarantees the debt, so the investors are not carrying any portion of the debt to the lender. And then another key point is on the construction cost, Denton Floyd on the construction side signs a guaranteed max price contract, which means that the amount that we're saying it costs to build at closing is what it costs to build. And if there's any sort of overruns on the construction end, Denton Floyd would eat that as a company. We would never come back to the lender to raise more debt or the equity investor to bring in more money to the deal. So whenever you sign that agreement to invest in the deal, you know that that's going to be your total investment, which I think is very beneficial and gives a lot of people a lot of comfort.
So I guess if you've taken the construction risk because you're going to guarantee that it's going to come in at the price, you've guaranteed the construction debt. So my risk really is, can you rent up as quickly as you say you're going to rent up and at the prices that you say? So how do I get comfortable? How does the investor get comfortable that you're going to be able to absorb that demand as quickly as you say, and that you're going to be able to do it at the rental rates that you say?
Well, you're exactly right. I mean, we've proven we can build it and build it for a good price. It really is about, can we lease it up at the prices that are in that model? So generally what you do is you look in the area before we start. We look and say, okay, what's the closest competitor that's there now? Is there another Class A property? And if so, how does it compare to our property? So when ours is finished, how will it look? And we look at what rents they're able to charge and how full they are, how much is their occupancy. And so you're going to see us go into areas where the competitors are at 80, 90% plus occupancy at a certain rent threshold that we will put into our book, and we will maybe adjust it a little bit. We might bump it $50. We might trend it to go up a little bit. So 2 years from now, when we're completed, it's going to be, maybe a little bit more. But you're able to see evidence that people in that area are willing to pay these rents to live in a similar asset. And when you look at the competition, you look at our product, generally you can get comfortable with the notion that, yep, when we build this, it's going to be a very, very attractive and competitive place. And we know there's population growth and income growth in the projected demographics for the area. We validated that jobs are coming, and they know the demand is likely to sustain the absorption.
I think one other key. Sorry, I didn't want to cut you off. I was going to say, I think one other key point about building the garden style versus a high rise. When you're building a high rise building, you have to turn over the building to the residents all at one time. So it typically takes 2 years to build. You start leasing them on 25. With a garden style project, since there's multiple buildings, you can section off buildings, and we deliver 3 buildings in a clubhouse in month 13. So you're getting extra cash flows from month 13 to 24 on a garden style project that you would never get in a wrap building. So by the time you're finished with construction on a garden style in month 24, you're anywhere between 45 and 65% leased compared to where you'd be 0% if you were building a high rise. So that gives a lot more downside risk to the investors because you're already getting cash flows early on in the project.
We're almost out of time. I got to ask you one last question. A lot of people in Canada are frankly worried about the investments in real estate right now because of risks about Donald Trump, your new president, and tariffs and what that's going to do to the economy. At the real estate forum, one of the senior people at Denton Floyd was asked what Trump's going to do to your economy, and the response was Trump is actually good for your economy, which should give people some confidence. Tell me, why do you think Trump is good for your economy in the Midwest U.S.?
I know we would get through this without a question about Trump. I just knew it was just a matter of time. So look, generally, companies make investments when the economy is good, when they have optimism that goods and services are going to be moving. And right now, there's optimism that our economy is going to get stronger. Now, the tariffs are going to be a factor. There are going to be some things that cost more in the near term. There's no doubt about that. We're in Kentucky, and the bourbon industry is looking at a real significant, headwind if they end up having to pay tariffs on all the barrels that they're importing and exporting. But for multifamily developers, what you want to see are investments being made by the employers, right? Because we're following jobs. So manufacturers, distribution companies, you want to see them making investments in areas where we build. They want to be building plants and building facilities. And the more of that takes place, that is a tide that literally lifts all the boats in multifamily, because ultimately it's about demand supply. And we look at areas we know that are slightly undersupplied, and when we see that demand come in, we're there to provide that supply to absorb it.
I think this is a really interesting investment opportunity. If you're at all interested, I would highly recommend you go to terracap.ca or nexuscrowd.ca, or send me a message on my website, briancrombie.com, and we'll give you some information about this opportunity. It's something that's not going to be right for everybody. You've got to be an accredited investor, which means you've got to have a certain net worth to invest in securities of this like. But if your alternative is thinking about buying a pre-construction condo and you're a little bit risk averse right now because of what's happening in the market, I think this is a really good, interesting opportunity. And diversifying away from investments in Canada and putting something into the United States, particularly into the Midwest, I think makes a ton of sense. A lot of Canadians have invested in Florida, which is still a good investment, but this would be a different kind of investment. Rather than going into a tourist-oriented, snowbird-oriented market, this would be economic development, economic growth, logistics, up and down the I-65 interstate. And so I think it's an interesting strategy. Go to terracap.ca, nexuscrowd.ca, or send me a message on my website, briancrombie.com. We're going to take a final break, and I'm going to come back after 2 minutes with a few concluding comments about investment in today's marketplace. Stay with us, everyone. Back in 2.